Essentially, if I were just to touch on a little bit of our mission, and then if you'll touch on the vision, I'll say that we're out there to help people know what their options are in regards to highly appreciated assets and how they can reinvest those without having to pay the taxes every time they buy and sell. You said, essentially, if somebody's looking at paying 20% capital gains tax on $1 million transaction, maybe a 3.8 Medicare tax, and maybe, you know, some state taxes like California, like upwards of 13.3%. So if they're paying over 40% in taxes with all of that nonsense, then this obviously, you know, I mean, shoot. Not only do they get to reinvest the bulk proceeds net of attorney fees rather than net of taxes, but they also get a dream team to supplement their existing team, not to necessarily replace or step on toes, but to help and assist with this higher level strategy, helping take them to the next level, so to speak. But if you're engaging with a letter of intent, if you are in the process and you think that in the near future, the next 60 to 90 days, you might be selling a highly appreciated asset, minimum of, hey, $1 million is an easy home run. That doesn't mean it has to be the minimum of the transaction, but it's a no-brainer at that point. $1 million net gain with at least $1 million transaction. A client of ours in Texas, he was in a competitive situation in trying to buy a business. So he's on the buyer's side. This is a little bit different outlook. But because he had watched our presentations, he presented not the highest bid, not the highest offer, but the offer that had the highest net gain or net cash flow to the seller. And he won, not because he offered the highest bid, but because he brought a strategy to the table that nobody else brought to the table that allowed the sellers to sell their construction business without having to chop up the proceeds to the various taxing agencies. And so that to your point, it's not always the sellers that are coming to us. Sometimes it's the M&A brokers. Sometimes it's the buyers themselves. But first question, if you were to sell your assets to a trust and then through a trust to a third party within 60 or 90 day period, wouldn't that be considered a short-term capital gain? Well, it would if the sales price were different, meaning it's pretty much a wash sale. It literally usually happens the day of or the day before of the actual sale of the asset. So we initially exchange a promissory note that stays in your estate for the asset that was in your estate. So it could be your business, your multifamily, it could be your own home, whatever it was. We're going to take that asset and we're going to put it into the trust. But of course, we have to exchange it for something of similar or same value. And literally the same day, the next day, so there's not any chance of actual price or value fluctuations or movement. We then sell the property out of the trust and receive proceeds into the trust. And the important thing here is that the asset that you sold is sold by the trust, and that the proceeds you receive are received at arm's length from you. They're received by the trust and not by you. So you've not received what's called constructive receipt. And of course, there's a lot of other rules and internal workings and everything else and how this all works. But mechanically, we set up a pre-sale before the real sale. The pre-sale is your asset, promissory note to you. Assets in the trust then sells it. Trust receives the proceeds. You didn't receive the proceeds. You don't have to pay the taxes. So that helps out quite a bit. Second question from Mike. Well, first, Mike, is any clarification needed there? We'll go on to the second.
That makes sense.
Okay, very good. Now, Mike, I'm going to go into the next one. And of course, feel free to interrupt me if I'm answering in a direction other than what you asked. But here it says the income the trust earns through its investments, are they taxed in the trust or only when withdrawn by the beneficiary? So the trust operates as a business trust and oftentimes as a loss entity. What does that mean? So there's a interest rate for the promissory note, regardless of whether you're paying it out in the moment of or not. Essentially, there's a lot of these phantom expenses that we're able to incur on behalf of the trust that oftentimes offsets conservative to moderate earnings inside of the trust. Should you, such as some tech company clients of mine, should you have very exorbitant gains there are other methods that we help offset that so that the trust itself does not have to pay taxes on the earnings inside of the trust. And we oftentimes work very closely with the tax attorney, and we implement these options from the very beginning so that you have everything set before you. A lot of it, as Pierce mentioned, will be evaluated based on your risk tolerance, what you plan, what your objectives are with the assets inside of the trust, what you hope to invest in. If your time horizon and risk tolerance are such that you hope to get 400% return, we're going to treat you very differently. And we're going to set up the trust a little bit. Well, the trust is going to be set up, but then we're going to augment the trust with a few other features so that we can help accommodate a tax favorable outcome for you in the use of the trust. Versus if you're the typical common individual that you have your business that has been the biggest, the best, the most lucrative thing of your life, and you sell your business or your multifamily home or what have you, and you just want to make sure that you don't lose any money or that you're very conservative and you have stable returns, then we don't have to be so fancy, because with the promissory note alone, oftentimes we're offsetting a lot of the gains that you'll have inside of the trust. Does that more or less help you with that question?
Yes, but so a little bit more into detail on that, right? So I understand that, if you sold an asset for $1 million, which was sold to you or the trust at the same value, and then you go make those investments, and let's say you buy something else, right? And if there's capital gains on that, not ordinary income from, collecting rents or whatnot, and now you sell that second piece of property for $2 million, right? So now you have $1 million capital gain coming into the trust. You're saying that's something that you guys can work with to create a tax strategy to defer some of those?
And I would say that's a very typical. I would say that we work with a lot, like Jay Carpenter mentioned, we work with a lot of real estate individuals who are doing exactly that. They're finding opportunities, and the power that this trust gives them over like a 1031. I mean, there's several properties that are not eligible for 1031, like your personal residence, right? But besides that, there's not the timing restrictions and limitations of the 45 days, the 180 days, all of these other limiting factors, right? So you're truly able to sell a property from the trust, receive the proceeds. In the interim, while you're waiting for the next opportunity, like even if it's ultra conservative, like treasury bills, what have you, we're doing better than money in just a bank account. And so let's say the next amazing deal is 187 days down the road. Fantastic. We're not limited. We can jump into that next opportunity deal. We can invest and we can sell again. Now, there's a certain way that we do this that usually optimizes, because, why would the trust need your depreciation? It doesn't need your depreciation. So a lot of times we do a joint venture with the trust. And I'm getting a little bit more into the weeds here, but just to let you know that there's a need and a purpose for this executive team that now works with you, because you might receive some benefits if you just purchase it all with the trust. You might receive double the benefits if you use the trust, a joint venture, depending on what your other income outside of the trust looks like. And so we like to optimize your not only your cash flow, but your tax flow, as Brett always says. Do you mind if I jump on the third question real fast?
Go ahead.
Yes. So who becomes the trustee of the trust, and how my vision implemented in the investment process? Well, we build everything around your vision. So I just want you to know that if this were a corporation, you would be the CEO, you and your significant other, spouse, what have you, or just you, whatever, you would be the CEO. And somebody such as myself would be like a CFO type person, just always bringing financial options to the table. And then the trustee is like the COO. He's the trigger man, or the guy that executes, the guy that does the stuff for purposes of the IRS. So when the IRS looks at something, they see Brett Swartz. They see capital gains tax solutions. But of course, Brett Swartz can't do anything without your signature and approval. So it's a two-step process for every decision, and that allows us to keep it at arm's length from you for tax purposes, but at the same time to accomplish your hopes and dreams in regards to your investment objectives.
I think the illusion of the control with the 1031 is the opposite of freedom. And we've been taught and we've been told that you want to swap into your drop into your swap, and that's freedom with 1031s and investments. Jay Carpenter and I just closed a deal, and his whole thing was he didn't have freedom. He had $10 million worth of 5 mobile home parks, and he felt like the 1031 was restricting his freedom. he felt like the ownership and the ongoing management and liability and ever-changing laws to collect his cash flow was restricting his freedom. And so the illusion of control with this idea of ownership is, I think, what the banks want us to think, right? Because the banks, they lend money all the time, and they're the richest in the world, right? The banks. And in the DST, you become the bank, right? You are lending the funds. And in a sense, yes, you are transferring some control. It's a better way to put it, Pierce. And indeed, you don't have unilateral decision making in order to do things. You got to work with me, the trustee. That is part of the deal. That is why we have integrity. But by the way, integrity of the tax law. That's also why an IRA or a 401k or a 1031 exchange itself, those 180 days, you are transferring control. You are following those rules laid out per the IRS guidelines for all of those different vehicles in order for you to defer your tax. And in this scenario, we're kind of like a long-term 1031 company where you are transferring that control, that unilateral control, not the ultimate control, because you have the protections of a lender. And the same reason a lender is not concerned that they're not going to get their payment and or they're not going to be able to have the control to close on the property or the asset, you have that same protection and all of those rights. And that is the illusion of control with the 1031, and that is actually the freedom of the Deferred Sales Trust.
We're trying to enable people to do more things. We're trying to enable people to truly invest in the assets they want to invest in the time that makes most sense. It's hard to find that opportunity purchase within any specific time limitation. But if you have power over the timing of when you recognize these transactions as taxable, then no longer are you rushed into other deals and transactions that may not be the right deal for you, or at least the right timing.
If they want to find you, where can they find you?
They can go to strategictaxsolutions.com, as well as 1-800-773-1848. And of course, you can find me in your book, Brett. Excited to be there and have my own little chapter, as well as all the great things we're helping people do, that we've helped people do in 2022 and that we're looking forward to in 2023.